Thanks very much, Ian. I'm Nick Erner, the Managing Director of the company, and today both myself and Ian Chalmers, Technical Director, will give a presentation because there's a fair bit going on in the geological section and exploration section of our business. We really wanted to dive into that, particularly talking about some of our main exploration targets that we have, particularly to extend the resource and reserves at Tomingley. So let me get into it. This is a presentation that I've given over a lot of the world and to a lot of different broking houses and funds here in Australia over the last 12 months to really try and highlight to everybody the wonderful base that we have for this business. We have two parts of the business. We have our operation at Tomingley and we have Boda Kaiser. And in the last 12 months, we've released, and it'll come up in the highlights, but we've released our 5-year plan for Tomingley and we put out the Boda Kaiser scoping study, as well as, of course, converting those to indicated resources. So these are the two parts of the business. This year we're on track to do between 70 and 80,000 ounces, and I'll dive a lot more into that at Tomingley. And then on the other part of our business, we've defined a capital project for Boda Kaiser that we're progressing forward through environmental approvals. Both contain value and both have two different time horizons. As well as that, I've got a few different highlights and a status update on Tomingley, but I really want to keep circling back to these two key elements of the business as it stands today. So let's look at what occurred over the last 12 months. Sometimes when you're really involved in a company or watching it, you think, well, you know, stuff seems to go pretty slowly. But then you just put up, this is just the last 12 months, and you put up what's happened. So we've increased the reserves at Roswell. So we arrived underground at Roswell, did pattern drilling out of the 15 by 20, and significantly increased the reserves at Roswell. And that's what underpins at least the next 5 years for the company. We've commenced stope ore production at Roswell. So we were bringing out development ore late last year, but we commenced stope ore production in April. And that's in full swing. That now makes up 70-80% of our ore source. We've implemented a whole heap of new efficiency measures, and I'll dive into that a little bit. But we've bought new equipment, particularly some new diesel electric loaders. We've got underground crib facilities. We've got an underground workshop and refuelling station. We've got an ore pass, all designed to increase the efficiency of that operation underground at Roswell compared to the more spread out operations that we had underneath Tomingley. We've built and finished a second tailings storage facility. We call it RSF2. That's operational and has been running for a little while. But the important thing about that is there's 3 million tonnes of storage capacity within that. We're approved for further lifts if we want them, but there's at least 3 years because when you put some tailings underground as paste, that's significant piece of infrastructure that's completed. We've built the paste plant. I'll dive into that more. It's ready to commission. We've constructed and commissioned the flotation of fine grind. I've got a video of that coming up. We've moved Boda Kaiser to indicated resources in both, completing the tail end of a 240-kilometre drill program. Ian will dive into that a bit more. And then, of course, we've completed the scoping study for Boda Kaiser. That's just the last 12 months. So fair bit's happened in that period of time. And our company has an excellent balance sheet. We're in good shape. I constantly hear people say, oh, wow, you guys, you've got your balance sheet under stress. You must be going to raise money. That is incorrect. That is incorrect. And there are some people in this room who have told me that, and they're wrong. We have $50 million of cash and bullion in the bank. We've only drawn 45 of our debt facility. We have 15 million available to draw. Last quarter, our cash balance as an entire group went down only $3 million. This year we're online for flat cash. This quarter we're online for flat. Next quarter we grow. We are a fully funded business, growing in cash. We are on track, and we'll dive into this quarter by quarter, to generate significant amounts of free cash across the next 2 years. It is flat wrong for people to think that we are under stress. Our shareholder base remains unchanged. Mr. Gandel holds 18% of the company. And I have spent a lot of time trying to shift the institutional base of our shareholding, because whilst we're 65% retail held, you can see from our stock we're quite volatile and our turnover is low. These two things both have an impact on share price. So we have people who move in and out of our stock in 1 day, 1 week, 3-month basis. We have long-term holders. But what we don't have is the capacity, when we only turn over $600,000 shares a day, we don't have the capacity for some fund who wishes to enter to take a substantial position. We need to increase the liquidity of our business. So I have met with funds in Europe who say, I want to put in $5 million into your business. How do I go about doing that? The only way they can go about doing that is to wait and buy shares on market at 100,000 a day for 6 to 8 weeks without influencing the share price. Funds do not do that. It's rare. I met one guy who's steadily accumulated $2.5 million worth, right? So one way to do that is to raise money. The other way to do that is to lift the share price and therefore increase the volatility. And those two are in tension with each other. But I'll address that more when I talk a little bit about how we intend to grow the business. A little bit on our debt and hedging. So we took this out in March 2023. And I don't think there's a single person who would have bet their house in March 2023 that the gold price was going to move from $2,850 to $4,000 an ounce. And if there is, good luck to them. Send me a note, but show me the trades. Don't just tell me, show me the trades, right? So we took out that debt position, which is why our hedging is where it is, right? So we have 81,700 ounces remain to hedge. We'll do another 6,000 odd of that will get paid in this quarter. That goes out to June 2027. That's the debt period to pay off the debt that we took out to increase our liquidity to do the works that I'm going to tell you about. So I have people say to me, wow, you were foolish to take out the hedges. I don't think they are correct, and I want to let you know, if you're considering putting shares into the company, I'm talking to people online as well, if you're considering buying our shares in the company, if we do a further development and take out debt, we will put in another form of gold price protection again. We'll either buy calls or buy puts, or we will take out hedging. But it will be at today's price, which will be 4,000, and the forward curve and the associated interest rates. Because to borrow money without protecting it is foolishness. That is our position as a board. That is our risk management framework. So if you want completely unexposed things, then look for another company that has either a massive amount of cash, and then ask why they're taking out debt when they have a massive amount of cash, apart from just increasing their availability, right? Or look for someone with a much, much, much greater risk appetite and understand that you're prepared to back someone that can blow up the company. Because the difference between a shareholder who can sell their shares when the gold price corrects to 3,000 and running a business is only one of us is left, and that's us running the business. The shareholder has left. That is why we take out gold price protection. And we took this out in March 2023 when the forward curve was 28.40. The really happy thing is, even this year, when our gold price, when our all-in sustaining cost is forecast between 2,400 and 2,600, that is still below the cost of our hedging. Everything is occurring exactly according to the financial plans that we set out with in March 2023. So that's the business as it stands, and we'll repay that debt across through to June 2027. And just to talk briefly on the puts, we can't sell at all the hedging at roughly 28.50, and the remaining gold, which is another sort of 2/3 of our gold production, none of that's going to get sold under $3,000 an ounce. So it doesn't matter what President Trump does. It doesn't matter what this is. If gold price corrects by 25%, it goes to 3,000. We won't be selling any gold under that between now and June 2027. So that's the corporate profile. Very happy to answer more questions around that, but I think it's pretty clear what I think. We're going to talk briefly about Tomingley, and I draw your attention to Varun Patel, our processing manager in the bottom right, because you're going to hear his voice a little bit going on. So top left, you have a picture of our Wyoming 1 pit, and the portal is in the just here in the bottom right of the screen. So, and obviously we make gold. Top right picture, and on the left, there we are underground. I've got a bit of video of that too to try and articulate to people a bit of what we do. So I'm just going to take the moment with a captive audience to recap the last period of time. So we poured our first gold, when was it? It was like February 14 or something. Yeah, February 14, right? And we built this plant through 2013. And I think for people to realise that we first started construction for that in about March 2013, and we were dry commissioning 9 months later, and we poured our first gold 11 months. So 11 months, start to finish. People forget that in today's environment, where people somehow seem to blow up stuff. People have said, we need to watch these guys and the developments that they're doing now in case it doesn't go well. We built the thing in 11 months. I'm baffled at people's ignorance. So we ran open cut mining, transitioned underground, ran the underground, and now we're going into our new mining area. And I'll dive a little, I've got this in quarter by quarter, I'll dive into it. But this growth comes because of the quality of the San Antonio and Roswell deposit, which we discovered. We didn't buy it. We didn't trade it. We didn't merge it. We generated the cash, drilled the holes, and we've developed it. The last time this company raised any money off the capital markets was in 2019, when we raised money to keep drilling Boda while we split out Australian Strategic Materials. I defy people to find junior single mine companies with that track record. Every single year in here, we have met our full year production guidance, except for last year, or exceeded it, except for last year when we did 57 and the bottom end of our guidance was 60. I defy people to find someone with that track record. So the capital project timing. We're past these now because these are complete. I've got a video of the commissioned flotation regrind. Of course, it still needs optimising, right? That's the nature of what's going on. And we start paste plant commissioning at the end of next week. So that's when the paste plant, I've got a picture of the paste plant. So what are we doing? What are we doing now? Well, now we're going to move the highway, and I go back. So this is the diversion of the Newell Highway, and that enables us to mine, and we're going to start with the 2 San Antonio open cuts. There's 200,000 ounces of gold in that, roughly, right? And so you do the maths, it's $50 million to move the highway, it's $35 million to upgrade the plant throughput, and then there's remaining expenditure on top of that. But that's what we're commencing. But the next stage of that is, despite us having all the approvals in place for this project, we have the need for our contractor that we're using to register their, which is a sort of a routine thing, register their environmental reports and management plans and stuff with the New South Wales government. That's underway at the moment, right? So we expect to get that about March, April next year, and then start moving into that road construction. There's pre-works and all the other stuff going on. There's 8.5 kilometres of highway there. We already own all the culverts. The design is 100% agreed. So there's independent audits, all this stuff you have to do, which you'd imagine it's a national highway between Melbourne and Brisbane. That's all done. All right, so we start that next year in about the March quarter, and we, current plan indications are we finish that at the end of the year. What are the things that could derail it? Well, a lot of wet weather. That'll push it back, right? That's the main thing. But what does that mean if it does get pushed back, or if the process plant throughput gets pushed back? This is quarter by quarter as we see it for the next 2 years. What it means if it gets pushed back is that we continue at the rate of, which is roughly 85 to 90 odd thousand ounces. We continue at that rate. And we simply don't move to 100 to 110,000 ounces until that work is complete. We are in great shape. All we have there is a delay to go to 100 or 110,000 ounces. And I'll come back to comment on the capital on that. So let's have a look. How are we increasing in production? Well, the main thing is that we're just mining into an area in Roswell that's higher grade in the next 12 to 18 months. That's just the way it is, right? The Roswell ore body has a large central higher grade portion. The reserve grade is 2.4, but of course there are bits that are above 2.4 and there are bits that are below 2.4. We are, as it happens, just mining through a sequence over the next 18 months where the grade slowly rises. We're in the core of that system going on. And that is open at depth, and Ian will, dive into that. So that moves us to, if you think back to the yearly guidance, this year is 70 to 80,000 ounces. Next year is 85 to 95,000 ounces, right? So we move into that. And it's then the open cut kicks in, which is why you can see throughput go up, having built the plant, and grade comes down because, of course, the open cut is lower grade because it costs less to mine it. And it's also why our sustaining capital falls away, which is why, combined with the increase in ounce, the all-in sustaining cost falls away. At the moment, and I have a picture coming up, at the moment we're doing 2 lots of development. We're developing up and we're developing down. So we're doing twice the amount of capital development. That falls away sort of May-ish next year. And hence we start to see the all-in sustaining cost fall. That's a one-off. This recovery, this is rising through this period of time because of the flotation and fine grind facility. That adds 7% to what we're doing, and I have a video coming up of that. And then, of course, the growth capital. The growth capital, we have $15 million roughly coming in this quarter that'll be sit here out of this 60 to 65. That's because we're finished now and we've got the last invoices to come. After that, we have 100, 110 odd million bucks to go out the door for the things I've described. That doesn't have to happen unless we want to move to 100 and 110,000 ounces, right? We are starting on the open cut. The reason why I talk about that in particular is, let's say another growth option, inorganic growth option, falls across our desk and we continually look for that, or we might choose to allocate 50 to 60 million bucks somewhere else. Let's say at Boda we drill, we hit something like Ridgeway and we think, oh, you know what, let's defer this and we'll drill out our Ridgeway and add, 40 million tonnes at 4 grams or something. Well, of course, then they're all different things we could choose to allocate capital. We're in very, very good shape. So the next 24 months will be very, very interesting. This is just to briefly articulate what I'm talking about at Roswell. So we've come in, we've got the underground crew room and vent fans and everything's all over here, developing up and down. You can see all the different intercepts we have there, grade control drilling, which are continuing to extend the resource. All I'm saying is this development, and some of the lateral development off this is increasing our all-in sustaining costs over this period of time. And then that falls away because we hit a steady state on that and we have enough mining fronts open up to mine at 1.1 million tonnes a year from underground. So let's have a look a bit. So we've got new underground equipment. One of the most interesting things is these 4 loaders. We don't always park them like this. But, if you're taking a promotional video together with WestTrack, it is a good place to park. So I've got a brief video and I'll try and give commentary in parallel. This is of the 2900 XE loaders operating underground. So they're a cat loader. They're diesel over electric. So as distinct from a diesel engine with a gearbox and transmission and all the other stuff that goes on, these are effectively like a diesel generator at the back driving an electric powered system, right? It's about 30% more efficient for fuel, and they have, theoretically, better torque on tyres and all the other things. The same as the difference between accelerating away in a Tesla versus me accelerating away in my Mazda 3. I mean, that's not the greatest equivalency difference, but you get the point. So, and a large part of it is that these operate under the CAT. You're going to see a video of the CAT command system, right, which is their method of remote operation and autonomous operation. I'll talk a little briefly about that at the end, because what you'll see in the video, one of our operators, moving stuff around. you can, with this system, and with other systems, but in what we have, you can say on one level. So we have an ore pass, right? So we can be mining at one level where we've got stopes that we want to bog out, and then we put into an ore pass, which means you're not interacting with a human in another loader loading a truck, which you'll see, another one of our operators loading a truck. So it means that you can say, these two remotes here, boom, 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 you wait here, you go and dump them here, no one goes into this level, and it just bogs out of the stope until it's done into the ore pass. Then you have people at the ore pass level. So here's a video coming up, and I will attempt to give commentary on that context. This is what it looks like at dawn. That's the plant. This is all context setting as we roll in underground. So that's down the ramp into the pit, one of the Epiroc trucks heading down to get loaded, heading into the portal. So that's the 2900 at the moment. This is being driven by an operator at the moment for an underground stockpile loading a truck. Here's one of the lads in, with the CAT commands. That's what they can see, the different screens, the map underground, which of course is all linked up. It maps itself, but also you load the plans in off the engineering dimensions. Oh, that's just a grader heading underground. And so, you can see that, what Glenn's done there is he's just thrown that into remote. And then at the bottom of the ore pass, we load again manually. You can see the low profile. The operators sit sideways, which is completely common in an underground LHD. And then we go back and park them in star style back on the stockpile once we've finished. So that's just a bit of a feel for what it's like underground. So of course we have drills and all the other stuff going underground. But I particularly wanted to point that out because when people look at our debt, we say we've got 45 million, but then we say, hang on a minute, the whole thing's 65. $19.2 million of that, which starts to get paid down this quarter, $19.2 million of that is equipment finance. So those are financed off CAT equipment. You could call it, for some, when I've spoken to a lot of Americans, they go, it's at least to buy. It's like, well, not really. It's, it's owned and you pay it off. But anyway, whatever it is, it's equal instalments over that period of time, which is that other part of the debt portion that you read. So this is the paste plant. This is constructed. There's just final dry checks. Let me describe this to you. So you've got the pipeline coming in from Tomingley, comes into here. We have a cyclone pack. You could, of course, recycle back if you wanted. We have a cyclone pack which separates the slimes out, like the ultrafines portion of your tailings. Your coarser portion goes into your tank. You feed across the belt filter. Actually feeds this way, across the belt filter, onto this belt, into a pug mill where you're mixing with cement and water. And then that goes underground, and you have pipe work and drill holes to go underground, and then it falls 300 metres. You have a distribution network of pipes underground. That is the paste plant. Very simple. Run all over the world. We've got people recruited that have run them before, etc., etc. So that goes live in 10 days. And what does that let us do? Just to reiterate, it lets us do full recovery of the ore underground. So you bog out a stope, and then rather than doing a certain amount and leaving a structural pillar of rock, you fill the whole thing up with a modest strength paste, and then you blast up against it. So that's the paste plant, and that's complete now. You're looking at circa $32 million worth of facility. We have a road network completed, and I'll just describe this because here's the new residue storage facility. There's the down into the pit that we saw before. Here's the plant. We come around under the underpass, which goes under the Newell Highway at the moment, and then we've built this. This is a light vehicle road, and you can see the tailings pipeline going to the paste plant beside it. This gets expanded in width to be a haul road over the next 12 months, all the way through. And then down just below this picture, this road here, which is a local road, Coalite Road, one of the reasons for these bends is, in fact, we build a new Coalite Road up through here, and then that has a bridge and we drive our trucks underneath it. So that's part of the road upgrade that's occurring. So that's coming in the next 12 months. But that road network has been built. And then this is the flotation and fine grind circuit, which is now operational. So let's recap, and Varun is then going to give us a tour of this. I'll pretend it's live, but it's not. So what does this do? Why have we done this? Well, we've always, in any ore body, but in ours in particular, after you finish leaching, you go and you do a tails analysis to work out, well, why didn't we get 100% recovery? And in ours, we've always had a fraction that is liberated if we grind finer. So, and that portion used to be 2-3%, and we had about 4-5%, which was truly bound refractory. So it's chemically bound, whereas this is just liberation bound. When we drilled out Coloma 2, that proportion increased slightly, and we thought, oh, should we grind that finer? The economics didn't really stack up. But then when we did Roswell, we found that, the Roswell recovery is about 84% with about, 9-10% liberation bound. And so this clearly became something to do to pay for itself. So this is about a $40 million facility, but if you take, the years of production we have ahead of us and you add a 7% recovery, which we think's conservative, depending on the, metallurgical area of the ore body that we're in for Roswell, then you get that. So what does this do? This takes our primary mill has always ground to about 105, 110-ish micron. So that's 0.11 of a millimetre, right? And so it feels like, fine sand. Then, what does this do? This takes that material and runs it through a set of flotation cells so that the concentrate that comes off the flotation cells, which contains the vast majority of gold, particularly in sulfide, then goes through and is ground to 12 micron. So significantly increases the liberation. But the percentage of mass is roughly, 20-25% of what comes in. It's then combined, and you'll hear Varun talk about that. It's then combined, and then all of that goes into the leach circuit, right? So you have some stuff going through at 110 micron and a whole bunch of stuff going through at 12 micron, and that significantly increases the recovery because everything can then be exposed to the cyanide and then, adsorb onto the carbon in the carbon leach circuit. That's why we've put it in, and it's very relevant down at Roswell. It also increases the recovery of the remaining bits that we have, because Ian's going to show you, we got a lot of ore still over at Coloma. That gets the benefit of this recovery as well. So here's a tour of the flotation and fine grind circuit. Varun is going to start up here and work his way through to here, and he's going to look over this side as well.
This is the float feed box that feeds the first float feed hopper, which has a density meter, which tells us what the density is to the flotation circuit. This is the bottom view of the float feed hopper. As you can see up there, there's the density gauge that tells us the density of the float feed circuit. The float feed hopper feeds the first flotation dilution tank, where we add water to get the right percent solids to feed the flotation circuit. The second tank is the conditioning tank, where we add packs and frother.
They're
Then
both
it is
flotation
followed
reagents.
by 5 flotation cells. We add frother and packs again to flotation cell 2 and to flotation cell fin. The front hopper in the end, that is the flotation con hopper, which feeds our flotation thickener. This is the first addition of packs and collector into the conditioning tank. This is rougher con 1 floating across into the con hopper. This is flotation con 2. Got flotation con 3. Flotation con 4. And flotation con 5. These all collect into the launder and overflows into the flotation con hopper, which feeds the flotation con thickener. The tails of all the flotation tails reports to the flotation tails hopper, which feeds the pre-leach thickener. Flotation tails reports to the feed box of the thickener and is gravity fed to the feed well where we add flop. This is the feed well with a bit of flop going in. Get a mix. And the clarity of the thickener.
That looks really good, by the way, if you're a process person.
Of the pre-leach thickener feeds the leach feed tank, which is combined with the isomill discharge. The overflow of the pre-leach thickener water gets pumped back to the process water dam. The flotation con is pumped to a flotation con thickener, and the thickener provides about 48% solids density back to the isomill feed tank, which is the flow we see at the moment. As you can see, it's got all the right minerals floated out of the float circuit, ready to be sent to the isomill for further regrinding. The isomill feed tank feeds the isomill feed hopper, which feeds to the front end of the isomill at a controlled density and flow. The feed end of the isomill followed by the discharge. The isomill discharge then reports back to the leach feed tank, combined with the flotation tail to feed the CIL circuit. There's a density meter on the slide to let us know and control the density to the CIL circuit as well.
So there you go. That's roughly $42 million worth of expenditure to put that in. So the blue item that you see is the isomill that has ceramic media in it, and that's what's grinding to 12 micron. So we're very excited about that. We're already seeing early recovery improvements within the plant, and I'll detail more of that in the quarterly report. The big job of this now is to optimise it, right? Like they are a very simple yet needs some finessing piece of equipment to operate, similar to the paste plant. So that is the flotation and fine grind that's absorbed a large part of energy, and we're really lucky to have a guy of Arun's quality leading that team. Another thing I want to reassure you is we do have production beyond 5 years, and Ian will talk about that. It's just when you look at all the different things that Ian's going to talk about geologically, the 5 years is pretty defined for us, but it's very difficult to say, well, where will we go and what will we do after that? And we're grade dependent, but we intend to be operating at that 100,000 ounce range. So now I'll talk briefly about Boda Kaiser, and I won't dive a lot into the geology. What I'll dive into is the scoping study, all right? Because Ian's going to take us a lot into the geology of what's occurred. Look, we've got 15 million ounces in resource, and I'll leave it to Ian to dive into this more. But here's the scoping study metrics, which, because I couldn't resist when gold was at 4,000, I updated the revenue to 4,000, but it doesn't really change anything at all. So, I said this at the time when we released this in mid-year, but we looked at 5, 10 and 20 million tonne per annum scenarios, because when you look back at the resource, you can see that this is greater than 1, the purple, right? You can see, hang on a minute, this could be mined in this manner. It goes really close, right? It goes really close, and we'll continue to look exploration-wise. But the IRR at the time went 13, 17, 24%, right? You can see the impact that the move from 3,500 to 4,000, that's had a 5% impact on IRR. It's very sensitive to gold price, of course. And so the economies of scale made more of a difference. What that means is, $1.8 billion Australian of pre-production capex. Of that, 1.3 is building the plant. 500 million of that is all the other stuff that you need to do road, land, power, water, tailings, etc., etc. So, sometimes we read other people's, estimates of things from overseas, and they've just looked at just the plant cost. But we've really tried to include everything that you need to do in that. So we're pretty comfortable with that, particularly at a scoping study level. And you can see this production, right? In the first 5 years, this works out roughly to be about a 280,000 ounce per annum gold mine, should you put it all into gold equivalent. And if you sell this copper at a price which is just above the spot price at the moment in US dollars, and you make that a credit, then you'd be selling it at $630 an ounce, right? And this is relevant when I come to talk about the path forward. Interestingly, if you thought, I just want to call this a 35,000 tonne per annum copper mine, and I make it a gold credit, then you produce the copper for free. So it's about 50-50 in revenue. Really good NPV, really good cash flows. So this payback period is just under 4 years. The issue, of course, that I get asked is, well, you guys, market cap at the moment 300 to 350 million. Even when Tomingley's hitting its straps at today's prices, it's going to be doing, 150 million free cash flow. How are you going to fund that? Well, we have been looking for a joint venture partner, and I'll dive into that. I'll dive into that in a moment. So two different paths that we've taken. One is to talk to copper people, and one is to talk to gold people, right? Because a lot of gold people are chasing copper credits. One, helps diversify their business, but two, it lets them say that their all-in sustaining cost is lower, right? Which is an important thing from a perception management perspective. The copper-only people, the broad majority of feedback fell into two camps. One was, there's just not enough copper per year to interest us, right? That was the really big boys. And the other one was, oh, we really like that, but, wait till you hit FID and then come and see us. We'll be really interested in doing something as part of a financing package or something like that. That makes perfect sense, right? So they're the people that we've approached. On the gold people that we've approached, we have a data room open. We welcome large and serious players into that to have a look. The vast majority of feedback is, yeah, we really like this. We're going to watch it. We want you to keep us updated. We don't feel any need to move at the moment into that. That's fair enough, right? Because everybody balances their different things. Some people are saying, oh, well, I'm focused on South America. Other people are saying, well, I've got a whole heap of exploration stuff myself. Other people are saying, you know what, I just took over another massive company. I'm really digesting that. That kind of theoretical type feedback. So very much we have people interested, but it's forming a part of their watching brief of a series of, 10 to 15 credible projects capable for execution. So what are we doing about that? Well, this was the 20 million tonne per annum pits. We'll continue to obviously optimise that. We're looking at, just got the scope in yesterday for, what would a sub-level cave look like under these, how that integrates. So we're continuing to understand that from a mining perspective. But most importantly, we're doing two things. Regional exploration, which Ian will talk about, because that could shift the economics of it. Might even shift the centroid of where you put a plant. But two, we're doing environmental studies commenced. People understand that is a massive amount of work, right? And the way things work in New South Wales is, broadly, you need at least 2 years of baseline environmental data to do any kind of impact statement. You need to understand the location of the plant because you're going to generate light and noise and all the other things that. You need to understand your mining method. You're going to do dust, so we understand that, but we don't understand yet the location of the plant. So we've made some assumptions for that. You've got to understand your impact on groundwater. You've got to understand where your employees are coming from, where your reagents come from. You're going to understand where you're piping your water from and your power. So this area has a lot of natural advantages. One is there's a whole heap of renewables projects in the area, so the power infrastructure connect is really good. The second is that it's very close to Wellington, so there's only sort of 13 to 20, depending which way you want to travel, type roads that may need upgrading for trucking and transport. We own some of the farmland underneath this already, but it's large landowners. There's not a whole series of hobby farms underneath it. And most importantly, it's quite close to the Macquarie River, and it's a modest distance from some of the saline water deposits, to the west of the coal mines on the east. But we need to run those things to ground, right? because we're capable of doing that. We've done that 3 times before, Tomingley, then the Dubbo project when Australian Strategic Materials was part of the company, and then again for Tomingley the second time. So we know our way around that pathway, so we're going to go on and get these studies done. Because you can imagine there's a complete difference to me in talking to someone saying, well, that process might take 5 years, and they say, well, okay, well, we'll watch that, but what if it's 4, what if it's 7? And me saying, oh, you know what, this is approved, right? We're just assembling the funding, right? A totally different thing. This is a $2 billion NPV, or 2.4 as it stands at the moment on today's prices. So, of course, the percentage of NPV that should reflect in our share price should change with those environmental studies. That does not cost us a lot of money to do. It's time-consuming. It can be very frustrating. But, we continue to work on that because anybody's going to have to do that, and we're as capable as anyone else. So that's what we're doing on Boda Kaiser, as well as, a pretty exciting exploration upside, which Ian will go to. So I can answer more questions on that later on. So let's look ahead. We're going to commission the paste plant and incorporate it in the mining sequence. That's simple, but of course, anyone that's been involved with that understands, that that's an important step. We're going to optimise what you just saw, and together with the ore throughput, there's a whole relationship between the speed you run the plant, the grind, the percentage of flotation you put. We want to stabilise that, right? There's an optimum position there financially for us. And we may be able to increase the throughput sufficiently that we start to wonder whether we should take that next step to go on to 1.5 million tonnes per annum. So we've really got to understand that well, embed that in. Ian's going to talk about this. We're expanding the Tomingley resource base. It's really interesting. When I talk to some investors, if we take the journey of the last few years, it's like, well, when are you going to get that approved? Oh, we've got that approved. Oh, when are you going to build these things? Oh, we've built those things. When are you going to increase the reserve? Oh, we've built the reserve. We've got 7 years out ahead of us now. So, oh, it's not 10. It's like, oh, we'll give it a go. But that's okay. We're actually working on a 5 megawatt solar plant at the moment, so we're going to finalise that in the supply agreement. That's in the sort of late stages of being signed off. That's one where power purchase agreement where someone else funds that and you buy the power off them over time. I'll come back and close this out at the end. We're going to do the Boda Kaiser environmental stuff, and then obviously Ian's going to talk about this regional exploration. Let me talk about this, and make it completely clear what we're doing here. So we have between 80 and 110,000 ounce, depending how you unpack it, mine that's going to generate in excess of $100 million cash flow for the next period of time, right? So out 2031, et cetera. People can do their net present values on that, and they'll come up with whatever number they want. Then you look at the premiums versus other companies, and you end up with a particular value. Then we have Boda out. Fastest approval on that is 5 odd years plus 2-year construction, 7 years. So we have short and long-term growth. But in terms of the medium-term growth plan, right, we don't have another production facility coming in. And I turn back to the challenge for us as a company. Our liquidity is low, right? So it's very difficult for large funds to take a position. Our medium-term growth doesn't exist, right? Our size and scale, so we could re-rate along with some of our peers, but we're going to be at the lower end, being at 80 to 100,000 ounces. We have other peers that are sort of in the 100 to 200,000 ounces. And all of these things impact on our share price, particularly on the people wanting to hold us in the register. Outside of free cash flow. So, of course, we're looking at a capital return strategy once we come into free cash flow, right? And we're yet to define that as a board, what that might look like, dividends or buybacks, because we're coming to a free cash period. But what we're looking at is two things. Can we buy or merge with another producer so that we increase our size and scale, number one? Or two, can we purchase, script-wise, a development project that uses the very large free cash flow in 26, 27, so that we're building something in 26, 27, which is therefore an inorganic medium-term opportunity. That is what we would like to do. We are one of the most successful single mine producers in Australia, but We don't want to be that. We want to de-risk. We want to be a multi-mine producer, right? And so you've seen us try that with different things, with Genesis, with Calidus, all these things. That's the purpose of it. That's what we're trying to do. And we think that there's a lot of shareholder value that can unlock with that, coupled with a capital return strategy. So we continue to evaluate. So we do that all the time, right? But it's about opportunity that actually coming. So hopefully we'll have something there, throughout the next 12 months, because we continue to work on it. So I'll just summarise again. We've got a really solid production base. We're generating cash flow, and we're ramping that up. And we have a big sleeping giant in Boda Kaiser, which we're doing the environmental studies that will only continue to add value. And of course, we're engaging with potential partners. So if anything happens, we want to have any major companies that are involved ready and able to act, because they're informed and aware of us and they're watching us closely. And I really want to iterate, we're capable of these things, all right? We have built and constructed plants before. We've operated successfully for 10 years. We've done plenty of environmental approvals. And so we continue to think that the stock presents a lot of value opportunity for shareholders, because we are significantly undervalued versus our peers. And I hope I've been able to articulate there's not a single fundamental reason why. Thank you. And I'll take questions on that before I pass to Ian. And if it's like, Ian's going to cover that, then I'll throw to Ian. And if there's no questions, because the presentation was just amazing, then I'm really happy with that as well. And so anyone got any questions on that sort of fundamental aspects of? Nope. Great. So, sorry, one there.
So the idea of you becoming a multi-mine operator, and I note the recent investment in Medallion.
Yeah.
Are you sort of constrained by jurisdiction?
Yes, it's a good question. So, if we look at development, right? So something that needs development, and whoever it is doesn't have a team yet, then we're constrained in these sort of Australia, New Zealand jurisdiction, because that's where our own expertise lies, where we understand. New South Wales, WA, it doesn't really matter, all right? We understand the jurisdiction, we're aware of the community issues, we're aware of the legislation, we know the contractors, right? So to develop something, we're in that jurisdiction. Operationally, much less so, right? Because if you merge with another operating group who obviously we'll obviously look at the risk profile, they already have an operating team that understands everything I've just described, right? So from a merger perspective, we're less constrained, but from a self-development perspective, we only look within Australia, New Zealand. And just very briefly, Ian and I will be giving these same presentations tomorrow in Melbourne, and then on Thursday morning in Sydney as well. So anyone online that thinks, I wish I'd sent a question in, then they can come and see us there. Great, thank you. I'll pass on to Ian. They were my extra slides in case someone asked me a question.